Hi everyone, welcome back to the channel. If you're managing rental properties or thinking of diving into real estate investments, today's topic is very important. We're going to uncover some of the most commonly missed tax deductions for rental properties. These aren't just random deductions, they are based on real experience from our decade plus of helping 7- and 8-figure clients. So let's get into it and make sure you're not leaving any money on the table. If you're new to the channel, my name is Andre Zagmout. I am a CPA, wealth advisor, an entrepreneur, and a real estate investor myself. I wanted to create these videos because I believe we have failed as a society to master financial literacy. Our parents failed to teach us how money works, most likely because they themselves had to struggle to learn and to reinvent the wheel. Our schools failed our students to teach them how to be financially independent. We teach kids how to read, write, geography, how to count, and all of the other good stuff. But we're not teaching them how to budget their finances, build wealth, not teaching kids assets and liabilities and how the market and taxes affect our lives. This is outrageous. Anyways, I would like to share my experience working with high net worth clients to help the middle folks explain and tax and financial strategies in a simple language and easy to follow steps to build wealth and minimize your taxes. Without further ado, let's dive in. Mortgage interest. This is usually one of your largest deductions and is pretty straightforward. If you're paying interest on a mortgage for rental property, the amount is deductible. For example, if you're paying $15,000 annually in interest, you can deduct all of that from your rental income. And this is not subject to the $750,000 mortgage limitation imposed on individuals owning their own home. So you can deduct the full interest on the mortgage regardless of the amount, provided the mortgage is used to finance a rental property. Real estate taxes. Real estate taxes on the property are also deductible. And the good thing is that they are not limited to the $10,000 limitation placed on state and local taxes you can deduct. Repairs and maintenance. This includes any reasonable costs to keep your property in good shape, like fixing leaks or repainting. It's important to differentiate these from improvements, as repairs are deductible immediately, while improvements must be depreciated over time. Special assessments. This one is tricky and often missed. If you are part of an association that levies special assessments for things like elevator or roof repairs, those can be deductible. It's a cost that many landlords overlook, but it can provide significant savings. Depreciation. It represents the natural wear and tear on your property over time. For residential properties, you can depreciate the building's value over 27 years and a half if the property is a residential one, like a condominium, duplexes, etc. If the property is a commercial one, then the depreciation is taken over 39-year life of the building. Surprisingly, it's a deduction that's most often overlooked by many landlords, which can be a huge miss. One caveat is land. Land cannot be depreciated. So you have to carve out the value of the land and the building out of the depreciation base. Association fees. While we are on topic of the associations, regular monthly association fees for things like maintenance and upkeep are fully deductible. These aren't just trivial amounts and can add up over the year. Insurance. Don't forget about insurance, whether it's a standard landlord insurance policy or additional liability coverage. These premiums are deductible. Sometimes these expenses are buried in your mortgage escrow statements and can be easily overlooked. So make sure to comb through your mortgage statements if you're paying your insurance through an escrow account, or through your bank statements if you are paying it outside of an escrow account. Utilities can also be deducted if you are the one paying them. Even if your tenant pays most utility bills, things like water or garbage collection might still be on your dime. Every expense counts, so make sure to deduct them if applicable. Commissions. If you use a broker or a third party to place tenants, the commissions you pay are deductible. This typically amounts to 1 month rent and is a standard cost of doing business as a landlord. Some companies or some management companies will charge you 3%, 3.5% to do things like background check, finding tenants. Those are considered commissions and are deductible on your tax return. Before we dive into more advanced tips, I would love to hear from you. Drop your comments or questions in the section below. I'm all ears. And hey, if you're enjoying this video, don't forget to give it a thumbs up and hit the subscribe button. That way you will stay in the loop on all things that are tax and finance. All right, let's move on to some advanced tips and strategies. Refinancing costs. When you refinance your rental property, don't ignore the potential deductions. You can amortize many of the closing costs over the life of the new mortgage, including points, providing ongoing tax relief. Travel expenses. If managing your properties requires travel, those expenses are deductible too, whether it's driving to different sites or flying out to manage long-distance properties. And make sure you don't deduct a vacation as a rental expense. That will not fly with the IRS. Keep detailed records of all these expenses just in case the government has any questions. Home office. For those managing rentals from home, a portion of your home expenses may be deductible. This includes part of your utilities, home insurance, and even mortgage interests, based on the percentage of your home used for business. Losses from casualties and thefts. Lastly, if your property is damaged or destroyed by events like fires or natural disasters, the unreimbursed losses are deductible. This also applies to thefts or vandalism. So if your insurance doesn't cover those costs, or you are paid an amount that is less than the actual damage, those losses may be deductible. Alright, understanding and utilizing these tax deductions can significantly reduce your tax burden and enhance your earnings from rental properties. It's not just about knowing these deductions exist, it's about applying them effectively and keeping a detailed record to support your claims should the government have any questions. If you find this video helpful, please give it a like, subscribe for more insights. Your fee for watching this video is to share it with a friend, someone who can benefit from these deductions. Most importantly, if you have any questions or additional tips you would like to share, drop them in the comments below. I would love to hear from you and add value to our community. Thanks for watching, and I'll see you in the next video.